There are very few financial concepts where I disagree with Warren Buffett. He's brilliant and thoughtful about any advice or opinions he puts out there. And for those of you who are just here to leave me a dislike for slandering Mr. Buffett's good name, I suppose I appreciate the engagement. That'll help boost this video, at least in the YouTube algorithm. But I hope you'll stick around to at least hear what I have to say. After all, I'm sure Buffett would encourage everyone to challenge the things that anyone, including himself, tells you in order to come with conviction to your own educated conclusions. That's how you grow as an individual. Heck, that's how he developed many of the practices and beliefs that he holds on to today. So although there are a handful of financial matters on which I disagree with Buffett, 2018's annual shareholder letter that was released over the weekend really highlighted one of them for me. I'd love to share that with you and know what you think about it. Hey there, my name is Steven Spicer, and it's my goal to help you invest smarter. And a big part of that is helping you identify some of the potentially ruinous flaws with the way almost everyone tells you to invest, which also happens to be the way Warren Buffett recommends that most people invest. And he brought up a few things in this letter that demonstrate that he understands and can relate to at least part of my concern. I think you'll see what I mean. Now, if you watched my last video on the takeaways from the annual letter, which you should, there were a lot of positive and valuable takeaways, I talked about how defensive Buffett is with Berkshire's significant cash equivalents and his words of caution about being prepared for something that has never happened before, to expect and be ready for the unexpected. I also talked in that video about how I agree with him about the need to prepare come what may. That's the reason I do what I do. That's the theme behind my book. You should be prepared. Where we disagree, however, is on that method of preparation. I don't think, and I hope this doesn't come off as too blasphemous to the traditional investing community, but I don't think the stock and bond only portfolio is enough to prepare for that mega catastrophe, Buffett's words, about which he is so concerned. He clearly uses cash, specifically United States fiat currency and its debt equivalents, to provide himself with that protective buffer. But still, I don't think that's enough, stocks, bonds, and cash. I think if you really want to prepare, you have to venture further, intelligently diversify more than that. I talked about that ad nauseum in my most popular video to date, so if you're looking for some specifics, that'd be a great place to start. I'll be sure and link to it and everything else, as I always do, in the description. But here's why it's not enough. Let's start with bonds. Most financial experts, professionals, your advisor, when they're running your analysis and talking about the returns that you should expect from bonds between now and the time that you retire, most of them will tell you to expect around a 5% return over time. Maybe they'll say worst case 3%. But they'll tell you that that's the conservative piece of your portfolio. They're the backbone should stocks crash, blah, blah, blah. Surely you've heard something along those lines. My biggest problem with this is that to get those numbers, most advisors are referring to the returns generated from bonds over the last few decades. That doesn't sound unreasonable. You see, from 1982 through today, bonds have averaged around that 5% per annum return. That's all the proof you need, right? So between now and the time you retire, whether that's a decade or two or more, you can reasonably expect 5% per year. Surely nothing below 3%, right? After all, that's what's happened over the last 4 decades. So there you go. Rest easy. The problem is that just because that's what's happened in the past, that doesn't mean that's exactly what you should expect in the future. The world just doesn't work like that. And the nice thing about the bond market, at least for me to make my case here, is that it's proven this very fact if you just look at the cycle before 1982. From 1953 through 1981, bonds averaged 0.2% return per year. Now, if you're counting on nothing less than 3%, that's going to hurt your projections. Like, big time. It might not seem like a big difference, but compound interest, it adds up. But even then, as Buffett says, that's not to say that something unexpected couldn't happen in the future, resulting in an even worse cycle than that one. Now, if you're looking for a little more color as to what I'm talking about with bonds, there's a section on it in my book. I also filled up an Instagram caption about it if you want to go follow me over there. And then we have cash. There's a whole world of concern there, but that's probably beyond the scope of this video specifically. So I'll just move past it and leave that to Peter Schiff or David at the Money GPS.
Is cash really king? That's what we're going to talk about today. You came here for the truth, so let me unveil that for you.
What I specifically want to address here is where Buffett, in his letter, elaborates on and justifies his case for stocks. And there's a part in the middle of this quote that really stood out to me. I'll highlight it for you. He says, if my $114.75 that he invested when he was 11 had been invested in a no-fee S&P 500 index fund and all dividends had been reinvested, my stake would have grown to be worth, pre-taxes, $606,811 on January 31st, 2019, the latest data available before the printing of this letter. That is a gain of $5,288 for one. Meanwhile, a $1 million investment in a tax-free institution of that time, say a pension fund or a college endowment, would have grown to about $5.3 billion. Those who regularly preach doom because of government budget deficits, as I regularly did myself for many years, might note that our country's national debt has increased roughly 400-fold during the last 77 years. That's 40,000%. Suppose you had foreseen this increase and panicked at the prospect of runaway deficits and a worthless currency. To protect yourself, you might have eschewed stocks and opted instead to buy 3¼ ounces of gold with your $114.75. And what would that supposed protection have delivered? You would now have an asset worth about $4,200. Less than 1% of what would have been realized from a simple unmanaged investment in American business. The magic metal was no match for the American metal. That's cute. These are great lessons for a student of history. Yes, gold in no way kept pace with the US stock market, but this information, this data from the past shouldn't be used to prove what will happen forever into the future. It doesn't work that way. Now, before I explain myself a little further with a couple of examples from history, let me say that I do still appreciate and love the perspective that he brings to this reality. He's right. If you told me today that the US national debt would increase by 40,000% over the next 77 years and everything would still be fine, well, I'd say no way. Impossible. Something will break first that will manifest in some way, and it'll be devastating. I think most people would say something along those lines. And I think that's the truth, but that's precisely his point. If presented with that same statistic 77 years ago, surely you would have thought it outlandishly impossible. Yet, here we are. Although I find that fascinating, it's in no way proof that American metal, as he puts it, can continue at this pace if, I'd like to say when, we finally suffer through the consequences of that out-of-control national debt. He actually brings up a really good point. How much further can it really go? Surely he's not suggesting that it could continue its trajectory without severe consequence at some point in the future, just because that's been the case for the last 77 years. I hope not. All his observation does is prove that it is possible for this to happen. And fine, I'll give him that. It is possible for us to go another 77 years at this pace without issue. It's kind of painful to say. Possible, yes. Highly, highly improbable. I think so. You get the idea. But I think it would be naive to plan your investments axiomatically assuming that that will be the case, that there won't be any issues, that everything will continue just like it has over the last 77 years. And sadly, that seems to be what educators and most professionals just continue to regurgitate. Now, if you watched the companion video to this one, I brought up Buffett's example of Russian roulette. You know the game where you have a 6-shooter pistol, but only one bullet in the chamber? You spin the chamber, you hold it up to your head, you pull the trigger. Now there are 5 chances that nothing will happen, and 1 that you end up dead. You pull the trigger. So if I offer you a large sum of money to play, is it a good idea? Should you do it? I mean, clearly the odds are stacked dramatically in your favor. No, the answer is no. And if you were tempted to answer yes to that, reach out to me. We can talk. But no. As Buffett said, a Russian roulette equation, usually win, occasionally die, would be madness. Rational people don't risk what they have and need for what they don't have and don't need. And with Russian roulette, you're aware of the odds. They're 5 to 1. But in the world of investments, you don't know those odds. And if we're talking about that mega catastrophe, the likes of which have never before been seen, the big one that Buffett mentioned, the odds of that happening versus a normal day in the market where the action is within what you expect, the odds are like 1 to thousands or tens of thousands. So as those catastrophic events don't happen, because they don't happen that often, people start to think that they won't, that they can't. Here, we can actually use history to prove my point. You see, you can prove that it's possible for something to happen just by one occurrence. But unfortunately, you can't do the opposite. You can't prove that something can never happen, no matter how much time passes without that occurrence. And history is riddled with examples of things that had never happened for decades or even centuries or ever before. It's riddled with examples of those things finally happening. I mean, there have been stock markets that have existed and even thrived before that don't exist anymore today. And I know that's extreme. That's not what I'm suggesting here, but it's true. But let's not get that crazy. Let's just look at a couple examples from the not too distant past, from the 1980s. I'll give you 2 here in this video, and we can talk about more later if you want. In both cases, history could have been used to provide a compelling case for why a certain event could never happen. But that history turned out to be a disastrously incorrect predictor of the future. Before October 1987, the Dow had never fallen more than 13% in a single day. Can't you imagine advisors and pundits saying that a drop of much more than that was impossible? That it'd be impossible? I mean, it had never happened before. There was roughly 90 years worth of evidence that it wouldn't. So surely it couldn't, right? Wrong. Way wrong. On Black Monday, October 19th, 1987, Black Tuesday for my Australian viewers, the Dow Jones Industrial Average fell a devastating 22.61% in a single day. Pundits were blindsided. Advisors panicked. The sky was falling. No one knew what to do. Everyday investors lost big. They didn't realize an event like that was possible, so they didn't prepare their portfolios or themselves mentally. My point? Just because something has never happened in the market before doesn't mean it can't or won't. And then there's Japan. Study Japan in the late 1980s and you'll discover a very similar scenario. From 1949 through 1989, the Nikkei 225, like our S&P 500, soared from like $40 to just about 40,000. It was a pretty consistent climb. Every time there was a dip, it predictably came right back up and just continued on up. 40 years of compelling data. This is what the market does. It just continues to go up no matter what. And if there ever was a dip or crash or recession, obviously, from that data, you should just stay the course, right? Because over the long run, the market always goes up, clearly, right? Sound familiar at all? Maybe to United States markets today? Well, it turns out that was the absolute wrong advice for someone investing in Japan in the late 1980s. The market fell over 80% over the next couple of decades. It didn't hit the bottom until 2009, if that even is the bottom. You see, the market still sits around half its former high. For Japanese investors, this time is known as the lost decades. It's been devastating, and history was not a correct predictor of the future. Now, I'm not predicting a crash here. I mean, I wouldn't be surprised, but this is not meant as a prediction. That's not the point of this video. The point is you can't use historical data, I don't care how much, to predict what will happen forever into the future. It is at least within the reasonable realm of possibility that a time will come where those who are doing that, investing in that way, under those assumptions, will be sorely disappointed. It can be a difficult pill to swallow. I get it. It means you'll need to take more responsibility for the way you're investing, which means more stress, more time, more concern. That's a hard reality. I get that. And I fully expect some dislikes for that reason alone.
I mean, if this video gets enough dislikes, it must be wrong, right?
I'm not selling sunshine and rainbows. That'd be much easier. But there weren't people, or at least not enough, sharing this message, this perspective. This is why I do what I do. This is why I left my industry career. This is why I've put most other ventures in my life on hold, because I want to help you. I want to help all of those who are interested to invest smarter. In fact, getting worked up about all this after reading Buffett's comments has reignited that flame. And if you're interested, I'm going to go back to the roots of my message and put together a couple videos exploring those potentially ruinous flaws with the way almost everyone tells you to invest. I hope you'll join us. Hit subscribe and the notification bell. Raise your hand in the comments. Agree or disagree, that's okay. Let me know where you're at with this. And let's start investing smarter. I'll see you in the next one.